All right. All right. Well, today we are going to discuss debt to income ratios. All right. This is 15 with Fallon. And if you haven't joined us before, thank you so much for joining us this morning. What we do here is we do quick calls for real estate agents and we discuss different topics each time to get you as successful as possible. You'll be able to talk the lingo, know what's going on in the industry. We'll discuss strategies and tips to get you more closings. So today, when we talk about debt to income ratio, also known as DTI, if you're fancy, we are going to discuss why it's so important for the buyer to understand how this works and also for you to understand how this works, because it is a moving number that is a huge determining factor of what your buyer can afford. So what we're going to do is we're going to do a quick calculation to go over this information, and that way you can see exactly what we're looking at. So let's just jump in and get started. So debt to income. Let's say we have a buyer that has a salary of $72,000 a year. Now, this is going to be simple because it's salary. It's guaranteed income. Every single one of their paychecks is going to be the same and guaranteed. So what you need to understand about debt to income ratio, it's not about what they make in a year. It's about what they make in a month. Every one of these numbers is going to come down to monthly income and monthly debt. Okay, so we're going to take that 72,000 and we're going to divide it by 12 months, and we get $6,000 a month in gross income. Another very important factor to understand is we're looking at gross income, not net income. Okay, so gross income is what you make before the taxes and everything comes out of the paycheck. Okay, so I wanted to make sure that's clear. All right, so this particular buyer, this is their debts, right? So this is their monthly debts. They have a car note, they have 2 credit cards, they have an installment loan, and altogether it's equaling about $700 a month. Now, I want you to notice here, we're not looking at their utilities, we're not looking at their car insurance or their Netflix subscription, gym membership. We are looking at the items that are reported to the credit bureau. Okay. Now, if they have not paid one of those things and it was sent to collections, then that's a whole different story. We take that into account in a different way. So notice here that this is the minimum monthly payments that the buyer owes. So they may, instead of paying $40 on this credit card, they may pay $80 one of the months. And that is fantastic. I'm all for it. However, for this calculation, we are going to do the minimum monthly payment. That is what lenders will do the calculation off of. Okay, so we have $700 in monthly debt. We are proposing a monthly housing note of $2,000. So what's in this housing note? So you have your principal and interest, you have your property taxes, you have your homeowner's insurance, you have your flood insurance if it's required, and your mortgage insurance. So all of that wrapped up into one, we're thinking it's going to be about $2,000 for this particular buyer. So we're going to take that $2,000 and we're going to add their monthly debt, $700, and we get $2,700. Is everyone still with me? We're still good. Give me a thumbs up if you are. See, again, simple calculations, math isn't all that bad. So you're going to take out your calculator now, if you have one in front of you, and you are going to take $2,700 divided by the $6,000, which is their gross income, and you will get 0.45. That is a percentage. So this particular buyer's debt to income ratio is 45% based on their income, their debt, and a monthly housing payment of $2,000. Okay, so that wasn't so bad, right? So what does all of this mean? Is 45 good? What number are we trying to stay under? Well, obviously, the lower the debt to income ratio, the better. But every loan type actually has a different threshold. So just to kind of give you an idea, a conventional loan, usually they'll let you push it to about 50%. USDA, you're looking more at 44, 45% max. And then FHA is actually one of the most flexible because it'll let you push it almost to 57% sometimes. But keep in mind, all of these max percentages is going to be based on the buyer's credit score. So those maxes are if the buyer's credit score is really great. Now, if the buyer's credit score is not, exactly the highest that it could be, these percentages may be lowered, but it just at least gives you a good idea of what they're looking for. So credit score is important when it comes to determining what is the max debt to income ratio. So I hear, and I'm sure you hear all the time, you'll have a potential buyer that'll say, oh, I cannot buy a house right now. I just bought a car. I owe $60,000 and there's just no way I'll get approved for a house. Well, this is when you need to ask them for more information, because what's happening is a lot of these buyers just believe because they owe $60,000 that they can't afford a house. But remember, we're looking at their monthly payment. So it doesn't matter if it's $60,000 that they're in debt or $1 million in debt. If whatever their minimum monthly payment for that debt fits into that debt to income ratio, that is all we are concerned about. That is the number that we need to get to and see what they can actually afford. And then also we have buyers on the flip side that just assume, I don't have a whole lot of debt. I only have 2 credit cards. So, I don't have a whole lot of debt. That should be easy peasy. Well, sometimes, even though they have maybe just the 2 credit cards or the 2 lines of credit, if their monthly payment is significantly high, then that could obviously affect them. So just something to keep in mind. Now, you do not necessarily want your buyer to be doing these calculations themselves, because like I said before, not everyone is salary these days. We're not seeing a whole lot of salaried employees. Employers are actually moving more toward hourly systems. So you'll see variable hours, you'll see commission programs, you'll see bonus structures, overtime structures. So with all of these moving factors, the paycheck is not the same every single week. So we as lenders have to do pretty complex calculations, a lot more complex than the one we just discussed here. So that's why we do ask for the documentation that we ask for, the pay stubs, the verification of employment, the tax returns. That's why we ask for all of these things in advance, because when you're paid with a commission or a bonus, we typically have to average this out over a period of time to make sure that it's actually usable. So another reason to get your buyer to a lender as quickly as possible, because just because they're like, oh, I made this much last year, I can definitely afford it, doesn't mean that on paper, we're going to come up with the same exact income scenario. So what can we do to lower the buyer's debt to income ratio? Because again, we want that as low as possible so they can have the opportunity to afford as much house as they need in order to find the house that they love, right? So a couple of ideas, and it all comes back to credit score. Work on the credit score. The higher the credit score, typically the lower the interest rate, which means the lower the monthly payment, which means the lower the ratio is. So credit score factors into this in so many different ways. You'll even see a difference sometimes in the homeowner's insurance based on the buyer's credit score. With private mortgage insurance, you could see a difference in the monthly private mortgage insurance based on the credit score. So it all comes back to that very, very important factor of score. Always be checking it, always be monitoring it, and always be working on it. Okay. So, and right now we're in a very unique situation especially here in Louisiana and other areas as well. But when we pre-approve a buyer, we're giving them a range. We're using an estimate of the homeowner's insurance that we think they're going to run into and the property tax of what we think they're going to purchase. But when it comes down to it and you have a buyer that is ready to go under contract, make sure you're talking with your lender, make sure rates are where they were when they first got pre-approved, and get a homeowner's quote. Okay, I work with some fantastic insurance brokers that are able to get me some great quotes. They are doing things like split policies and just creative ways of working with contents coverages to help the buyers out in order to make these numbers fit within the debt to income range. But another option that we are seeing work quite often now is have your buyer reach out to whoever they have their auto insurance through and see if they could possibly bundle the homeowner's insurance with their auto insurance. And you may see quite a bit of a discount. It can be very, very helpful. So that's just another one of the tips. But insurance is, usually one of the main factors that the debt to income ratio will hinge on, especially these days. So you want to make sure you don't waste your time putting together offers and negotiating offers without knowing what that number is going to be, what that insurance premium is going to be. Okay. And then also when you're shopping, if you have a buyer that is kind of pushing that ratio, you may want to avoid some flood hazardous areas where flood insurance would be required. You may want to avoid houses with maybe older roofs or older AC units, because those typically they have a lifespan that is coming to the end and they're high ticket items. So many times the insurance premium will take that into account, knowing they'll probably have to replace the roof or the AC unit soon. So just some things that you may want to avoid if you know you're right at that cusp and you're not sure if it's going to be approvable. So, and then again, another one of the suggestions that I have is when you can ask for seller concessions, get seller concessions. Cash is so important. Assets are key because when you have that additional funds to help pay those closing costs, then you can free up your buyer's assets to pay down debt or even possibly pay down the rate. There's different things that they can do with it that's a lot more useful. Which brings me to my very last point is I have buyers very often that they're searching around, they're looking, they're interested, but they keep putting off the application process. And a lot of the reasoning is, okay, I don't want to do this now. I have some things that I need to work on. I have some things that I need to pay down. But as soon as I pay those down and do this, that, and the other, then I'll fill out the application so I can see what I'm pre-approved for. And although I absolutely appreciate them doing as much of this work up front, sometimes it's not the best idea because I will finally get the app, take a look at their situation and realize that they may have spent a few $1,000s of their hard-earned money paying down debts that don't necessarily help with their credit score or their debt to income ratio as much as maybe that money could have, helped going in a different direction. So if you are talking to a lender that knows what they're doing, they will give your buyer guidance. They will give your buyer a game plan. So they need to get started right now with the process so they know exactly where to put those funds and get the biggest bang for their buck and get that credit score where it needs to be and also afford the house that they want. So that is debt to income in a nutshell. I hope that kind of, made it a little bit simpler to wrap your head around. If you have any questions about debt to income ratio or anything else, mortgage or industry related, obviously, you can always reach out to me. I sincerely appreciate you guys joining us this morning. And until next time, happy selling. Bye-bye.